This is why you are still losing a lot of trades. You are not taking into account your higher time frame key levels and your higher time frame narrative. Because a lot of you guys are getting messed up with the lower time frame executions because you don't have a clear image of what the higher time frame is currently doing. Here you have an example. For the sake of this video, we are going to assume that the hourly is my higher time frame and the 5 minute is my lower time frame to keep things simple. Here, on the higher time frame, which is the hourly, you get this sweep on sell side liquidity and price has a strong displacement higher. What does that strong displacement higher give you? A market structure break. So now on the higher time frame, we are bullish. Price has taken out this sell side liquidity to accumulate longs and switch from a sell program to a buy program to now distribute price higher and hopefully take out these draws on liquidity in the form of buy side liquidity. Here you have your relatively equal highs, right? And then eventually your overall draw on liquidity, which will be this high. Now, even though for this video the hourly is my higher time frame, this doesn't mean I could go on to the even higher time frame to depict a better picture. So on the daily, bullish narrative, price tapped into this bullish order block, and that is where we had that strong bullish reaction on the hourly. So because the daily is bullish, you would anticipate for the buy side liquidity to give way. Hence why on the hourly, after we had the switch from sell program to a buy program, with this market structure break and displacement, we could anticipate for these buy side liquidity to be our next target. Easier said than done, right? Because this is where most of the problems come from. Even though for a lot of you, it is easy to say that on the higher time frame, we are bullish now, you are still too glued to the lower time frame. If I play this out, look at what it shows on the lower time frame. It gives you displacement lower, disrespecting discount arrays and respecting premium arrays. Your idea could be, we took out this buy side liquidity, so after taking out this buy side liquidity, price would have to retrace before continuing higher. And that is where you have your confirmation on the lower time frame to go bearish. So here, you would think price was going to retrace from here after we had that bearish confirmation with the change in state of delivery. Stop loss just above here, you enter there, target, let's say, fix 2R. Tags you in. But look what happens. Price continues going higher, even though it gave you that bearish confirmation after price took out this buy side liquidity. Why does it continue to go higher? Because your higher time frame direction is bullish and your draws on liquidity is very clear here. This buy side liquidity, this buy side liquidity, and this buy side liquidity. So there's strong conviction in anticipating where price is likely to go on the higher time frame after you had that bullish market structure and these draws on liquidity, which is in line with your daily direction. So any bearish price action here is unclear because you don't know how far price is going to retrace to, as opposed to simply catching the continuation of this bullish trend, because you know for sure the price is going to this buy side liquidity and then eventually this overall buy side liquidity to follow your higher time frame direction. When price takes out these buy side liquidity, yes, it could retrace before continuing higher, but it is very low probability in comparison to simply following the trend, right? Because you don't know where it is going to retrace to and stop at. Because here, there are many key levels that price can retrace to, stop at before continuing higher. Whereas here, you only need to focus on the highs and the overall bullish direction. What you're essentially doing when you're looking for bearish confirmation on the lower time frame here, in this bullish high time frame scenario, you are trying to catch the top. And that is why you're constantly losing trades, because you fail to stay patient, wait for it to tap into a key level, give you that bullish confirmation, and then take price higher to follow your higher time frame bullish direction. The highest probability trades always comes from following your higher time frame direction. In trading, you're not trying to catch every single move. You're not trying to catch expansion, retracement, expansion, retracement, expansion, right? It becomes so simple when all you have to do is to just wait for price to come into a key discount level in this bullish scenario, and then go down onto a lower time frame and wait for it to align bullish, and then catch your trades from there. As opposed to here, 5 minutes. Let's play price out again. Sweep on liquidity, buy side liquidity, and then it gives you a strong displacement lower, giving you a market structure break. Very clear bearish confirmation, right? Here you would think we're going short. So you will short again. Taps you in. Look what happens. Price continues going higher, even though it's giving you a very clear bearish market structure break with strong displacement, as well as a sweep on buy side liquidity, but price still continues to go bullish. Why? Hourly, we are bullish. There's no reason trying to catch the top. And any bearish price action on the lower time frame should only be seen as minor retracements to accumulate positions before continuing higher. So that's the key lesson for today. The reason why you guys are constantly losing trades is because even though you are aware of the higher time frame direction and where it is going, you fail to stay patient and wait for price to come back to a key level and then take it higher. And it's even worse if a lot of you are unaware of what the higher time frame direction is currently telling you. Because the majority of traders who fail don't take into account your higher time frame direction. This is another example here. On the hourly now, this is a bearish example. Price is clearly going bearish on the hourly, which is my higher time frame. And you know that from hindsight, price comes back to rebalance this old inefficiency before it seeks liquidity to follow the bearish direction. But here, if I draw down to the 5 minute, a lot of you would simply be glued to the lower time frame. You would see this market structure shift to go bullish on the lower time frame, and it shows you heavy displacement. And this is where you would look to enter, possibly targeting this high because you would think that price is going to reverse from here. But as I'm sure you guys are aware, it displaces heavily through that stop loss and takes you out. Why? Because on the hourly, all it was doing was rebalancing an old inefficiency before taking price lower. You guys are constantly trying to catch the top and bottoms, not taking into account what the higher time frame direction is currently telling you. Your lower time frame should only be used for your execution confirmation, but that is nothing if you don't have the higher time frame direction aligned. So if we go back to this example, you can see that what we are currently forming is a market maker buy model on the higher time frame. This being your original consolidation, and these minor displacement becomes your old accumulation levels turned distribution. You would anticipate for price to trade through these accumulation levels and then come back to it, turning this accumulation level into a distribution level to support price higher and take out this overall buy side liquidity. So let's play price out. See that? Trades past it and then it comes back. What does that look like on the 5 minute? Again, the same thing. It looks like a bearish market structure shift. Yeah? You have a break in market structure. With heavy displacement, price comes back, respects this premium array before continuing lower and give you another break. And this is where dumb money will look to short off of this imbalance. Stop loss just above the high, and then you would target somewhere down here. And we know it tags you in, runs for a bit of profit, and then eventually takes you out. And again, this is you trying to catch the high when price is still heavily bullish and we are currently in the market maker buy model. So we know that that minor bearish price action on the lower time frame was to simply retrace into this old accumulation level to, like I said, turn it into a distribution level and support price higher to take out this buy side liquidity, which is where your original consolidation is. So if you get out of that mindset of trying to short every single high because you want to catch the initial move, that will significantly decrease your losses. And a proper way to look at this bearish price action here is that it is to retrace into a discount array to accumulate more positions and support price higher. So let's go back down to the 5 minute. This bearish market structure shift, you know that it was simply a fake to retrace into this discount level. So let's keep playing price out and see what it does. Here, again, it gives you another market structure break to the downside. But now we know that this market structure break is to either retrace deeper into this old accumulation level or to sweep liquidity here to accumulate more positions before taking price higher. You should always assume that any bearish price action on the lower time frame when the higher time frame direction is bullish is only temporary, and the top is unlikely going to be implemented unless we get a higher time frame reversal. Your lower time frame is very weak in comparison to your higher time frame direction. So here, again, it shows you very convincing signs to go bearish, but your higher time frame is bullish. So don't get caught up in this bearish price action trying to be one of the first players to catch the high. But look, all it does is to simply come back here, seek liquidity, tap deeper into your accumulation level, and then that is where you had your strong displacement higher. Look at all these bullish candles, look at the sizes of them in comparison to this steady bearish order flow. So instead of jumping the gun and taking a short here, all you have to do was wait for the lower time frame to align bullish with your higher time frame direction, which is what you had here, giving you a market structure break. And this is where you could enter at this imbalance or this bullish order block. Stop loss just below this low. And you could look to target a fixed R, let's say 3R. and then it hits your TP. All you had to do was wait a couple of hours for price to realign bullish with your high time frame direction, and then once it realigns with your high time frame direction, it becomes very easy and stress-free. You're not constantly stressing yourself out thinking whether this high is the true high in place and whether you missed the move or not, because your high time frame direction is again bullish. So let's look at it from a diagram standpoint. Imagine this is a bearish scenario, which is also your market maker sell model. This black line being your high time frame, and let's make it our low time frame, the red line. So here, we had this bearish market structure break. So on this half, which is your sell curve, that is where you have higher time frame bearish direction. So you guys should be aware by now what gets left there. A breaker block, and price comes back to this breaker block before continuing lower. So on a high time frame, this was simply just a retracement into this bearish breaker block before continuing lower. But what does that look like on the lower time frame? It will look like this. You get your bullish market structure break with convincing displacement. Right, so on the lower time frame, it has switched bullish. And this is where the main problem lies for you guys. Because you simply cannot wait for it to retrace and then just catch the short. You enter in a long here. Because it's giving you, on the lower time frame, that bullish confirmation that it's going to continue higher. So this is where you would enter, thinking that the low was in place. And this is why your high time frame is always so important. Because you know that this bullish price action was only temporary and it was simply just a retracement into this higher time frame premium level before it distributes price lower, right? Again, same thing here. This could be an imbalance that gets left behind that price has to come back and rebalance that old efficiency before continuing lower. And again, a lot of you will fall into the same trap of thinking that the low is in place and entering a long after the lower time frame gives you that bullish confirmation. You want to be a part of every single move and follow whatever the lower time frame is showing you, not taking into account the higher time frame direction. Your highest probability trades will always be the ones that align with your high time frame direction. When price retraces to this imbalance, all you had to do was wait for the lower time frame to give you that bearish confirmation, enter in the short here and catch the distribution. Not only is this risk to reward ratio much higher, but it is much more higher probability because you know where the lower time frame is going to be headed for, as it is aligned with your higher time frame direction. So that concludes this video. If you guys found this video helpful, please like and subscribe. If you have any questions or suggestions for future videos, please leave them below in the comments. Like always, take care and I'll see you guys in the next one.